Good morning. This is Larry McMillan with a market update on Monday, October 19th, before the market opens. For those of you who are around in 1987 trading, Monday, October 19th was not a very good day. It was a crash of 87, but we're not near that kind of situation right now, hopefully. Last week on Monday, the S&P was up about 60 points. Third day in a row that had gapped. Call buying was tremendously heavy, and we've been paying the price for that ever since. The market's been backing off a little, not a lot, trying to alleviate what has become an overbought situation already. And but right now the S&P index is still positive. We have a support at a minor support at last week's lows around 34.42. We did close two of the gaps that existed on the chart, so that's helpful. And in my opinion, as long as we're above 3,400, the Bulls still have the football, let's say. On the upside, there is a little resistance at 35.50, which was the highs of last Monday, and then of course the all-time highs at 35.88. On the downside, if we broke 3,400, there is support at 3,300 and then again at 3,200. But if we start talking about those numbers, I'd say we're back in a bearish situation. So right now, the S&P chart is still bullish as long as it's holding above 3,400. The equity-only put-call ratios have turned lower because of all the call buying that went on last week. For example, the CBOE equity-only put-call ratio was below 50 every day last week. In other words, more calls traded than puts every day last week. That's unusual, and more than that, it's more than twice as many calls as puts, I should say. It's below 50. So that's an overbought situation, but overbought doesn't mean sell. So these ratios are moving lower again. They didn't really get that high. I would not say the put call ratios alleviated any kind of overbought situation from where they were early September. So they're still in a dangerous spot, but right now they're moving lower, and that's bullish as long as that continues. Breadth has been pretty good, although it did weaken some last week. So our stocks only oscillator remains on a buy signal, but the New York Stock Exchange oscillator has rolled over to a sell signal. Perhaps more importantly, though, is the fact that we have what we call an oscillator differential buy signal. Between the two got very spread wide apart, and now they've contracted together. That's a buy signal for the short term, let's say for this week or so. That also leads to cumulative breadth, which is still holding in there. The cumulative breadth indicators made new all-time highs last Monday, and especially the volume indicator is indicative of the fact that S&P should also then follow along to a new all-time high. New highs continue to outpace new lows. That hasn't been a problem for the market really at all going along. So that brings us to Vix Volatility. Again, Vix is preoccupied with what's going to happen after the election, but it's holding above 25, so it's relatively expensive. And the 30-day moving average, the 200-day moving average is above 30 and still rising. So that's a bit worrisome as well. We'll probably won't see Vix return to its normal market predictive status until the election is over, and even the aftermath of the election is over, which S&P options still indicate there could be problems as far out as December. So all in all, we're still bullish for the short term. Close below 3,400 would change that. I invite you to attend our Saturday seminar coming up this Saturday, October 24th. We'll have a stock market discussion, a question and answer session, and then a webinar on volatility trading. Also, our newsletters are still doing quite well, and I invite you to take a look at those. We certainly have specials on those from time to time. So thanks for listening and watching, and have a great week trading.